Question number 5 on depreciation. Ram purchased a machinery for rupees 20,000 on 1st April 2011. So underline the date and the amount. The machinery is depreciated at the rate 10% on original cost. That means that it is a straight line method of depreciation. On 1st October 2013, the machinery was sold for rupees 12,000. On 1st October 2013, prepare machinery account and provision for depreciation account. Now the point to be noted here is machinery account and provision for depreciation account means no depreciation account has to be open. It is provision for depreciation, and we will learn that how do we post entries in provision for depreciation in this question. Okay, let's start. First of all, machinery was purchased, so machinery account debit to bank. So it is 2011, 1st April to bank, that is 20,000. When we have a provision for depreciation, we don't less depreciation from the machinery account. We directly put it in the provision for depreciation account. So on 31st March 2012, 31st March, the closing balance will be as it is, that is 20,000. By balance carried down 20,000. Until and unless you sell the machinery, you don't give the depreciation effect here. Okay, and for provision for depreciation account, I will have depreciation as 20,000 into 10%, that is 2,000. So my entry on 31st March will be depreciation account debit to provision for depreciation account. So 2012, 31st March. Here I will do the depreciation entry and not in the machinery account. It will be depreciation account debit to provision for depreciation account. So by depreciation, $2,000 is put here, and on 31st March I'll keep the balance. To balance carried down 2,000 is here, and then get the balance down in the next year, that is 1st April 2012. It will be by balance brought down, that is 2,000. Okay, in April, from 1st April 2012 to 31st March 13, we have done nothing, so it will be just marked as 1st April 2012 to balance brought down. 20,000 is as it is, and I don't deduct depreciation when I have a provision for depreciation in machinery account. So 31st March 2013 is by balance carried down 20,000, and next year 1st April 2013 is your to balance brought down, which is 20,000. here simultaneously I will do the depreciation entry for 1st April 2012 to 31st March 2013. So on 31st March 2013 I will pass the entry of depreciation. Depreciation account debit to provision for depreciation. So by depreciation 2000, 2 plus 2 is 4, and the balance to be carried will be on 31st March 2013. The balance to be carried will be 2 balance carried down, which will be 4,000, and the total being 4,000. You understood or not, this is the concept where in machinery account you will never write depreciation entry because you already have a provision for depreciation account. So all the depreciation entries will flow through your provision for depreciation account. So on 1st April now 13, the opening balance is by balance carried down 4,000. Okay, now there is some information on sales of machinery. So let's read that. On 1st October 13 means April, May, June, July, August, September. 6 months depreciation has to be charged because on 1st October it has been sold. So on 1st October 13, the machinery was sold for rupees 12,000. So till 1st October 13 I need to know the depreciation. So by depreciation here, how much? On 20,000, it is straight line method. So on 20,000 I will charge depreciation at the rate 10% for 6 months only. So 6 by 12 into 6 by 12, which comes up to 1,000. So the total being 5,000, and over here I will write the balance to machinery account because now the machinery is being sold. So to machinery account, how much? 5,000, and this is on your 1st October 13, 2013. So what entry will I pass? Now I will close the provision and take it to the machinery account because machinery is being sold for rupees 12,000. So on 1st October 13, first I will do the bank entry for receipt of 12,000 rupees by bank, that is 12,000. Now for the total figure which I will take from here, provision by provision for depreciation, at the time of sales I have to record it. So by provision for depreciation, that is 5,000, and the balance will be my profit or loss. So this side total seems more, 20,000, 20,000, and it will be by profit oblique loss. So it's a loss by loss on sale of machinery carried to P&L account. Other way is to write by P&L account, and it is 3,000. So this is the way when I have to make a provision for depreciation account. I will not do the depreciation entries in your machinery account. Directly take it to provision for depreciation account, and when I am selling it, I will take this figure into consideration, that for how much am I selling it, how much is the provision for depreciation, and from the balance I will subtract the two to get the profit or the loss.